Former CBO Director, American Action Forum President Doug Holtz-Eakin. Doug, good to see you. Good morning to you.
Morning, Maria.
What's
How you
your
doing?
take on all of this? I mean, you know, she's got all of these super delegates, but Bernie Sanders keeps making the case, is it even fair that she had 400 delegates even before the first vote was cast? And as Kevin just mentioned, we had the head of the nurses union on last week. She said, we're going to be making noise outside and inside at that convention.
Well, I think this is the big difference between the parties this year. The Republicans gave up on the idea of superdelegates, and you see someone like Donald Trump sweep to the presumed nominee. On the Democratic side, the superdelegates give the establishment their voice, and I think there's going to be a growing pressure to get rid of them, but you can bet that the party leaders don't want to give them up easily because they are the way they maintain control.
Yeah, you know, we got to talk about the economy because the number one issue has gone back and forth from national security to the economy. That jobs report was a disaster on Friday. 38,000 new jobs added for the month, the lowest number in 6 years, and almost 500,000 people actually dropped out of the labor force. People were looking for 160,000 jobs. It was 38,000. Doug, what does this tell us about where we are right now?
This was really bad news. I think the worst number in the whole report was the 468,000 people who were working part-time for economic reasons. There's slack demand, inability to get full-time work. That's a terrible number at this point in the recovery. So if you look over the past 3 months, we've had employment growth growing at roughly the population growth. That's the kind of behavior you get near the peak of a business cycle. It's hard to imagine going south from here because we haven't done that well to begin with. But yeah. I think there's a lot of reason to be concerned.
Anthony Scaramucci, the first comment that we were all on the panel together, and they were shocked when the 38,000 number first. No, there really was. We thought it was a mistake. And the first thing I thought was, no way the Fed's going to raise rates June 15th. So Janet Yellen speaking today, you think we'll get a hint at?
Yeah, well, I think she has to take the June off the table. But here's what everybody forgets. Okay, the reason they want to raise rates has to do with the fact they have no ammunition. So you typically need 400 basis points of stimulation for an economy like ours at this point in the cycle. They have no ammo in the gun right now, and so that's one of the big issues here. That's the tension inside the Federal Reserve right now.
That's the article that John Hilsenrath co-wrote in the Wall Street Journal today, and they write exactly a rate increase in the June 14-15 meeting is almost surely off the table.
Well, you've been saying that for 6 months. You could have written the article yourself because you've been saying that the central banks of the world are out of ammo.
Right, and then a move in July is still possible, although less likely, according to Hilsenrath.
One of the most important things we need to take away about Janet Yellen speaking today is her guidance going forward. I would argue that it wasn't the quarter rate hike move in December that moved markets. It was the guidance of raising 4 more times this year. So she's probably going to indicate there may be 1 more rate hike. But if she indicates they may raise even 1 more time after that, 2 more times, I think that would spook the markets.
My question to Doug is that these are still emergency level monetary policy numbers. And so, you know, if you were the chairman of the Federal Reserve, would you be moving rates here given these numbers that you're seeing? You know, data-dependent numbers.
Yeah, look, I think the Fed has this wrong. I think they've been entirely too spooked by near-term market reactions to their guidance and their moves. I think they should be raising in June. The reality is they don't have much ammo to make the economy grow faster. They're also not going to slow it down much. I mean, we're into the fundamentals of the business cycle. We could do some good things with tax policy. But the Fed's really not got the power that it thinks it has. And it's certainly at this point with a 4.7 unemployment rate and year-over-year inflation, especially core inflation, around 2%, they should be much closer to normal, and they should start getting there and watching the real economy as they do it, spending less time worrying about the markets.
Yeah,
having said all that, they're not going to move in June.
They're not going to move in June. And by the way, the implications...
they'll repeat that mistake, and then they'll repeat the mistake in July.
The implications of low rates, we've seen it, you know, from deals to encouraging stock buybacks. There's another story in the Journal today about how an economist is saying, look, these rock-bottom rates is dictating balance sheets, and that's why you're seeing so many dividends. But wait, I got to get into the Brexit story because this is another issue for markets, Doug. There are new polls over the weekend that show that there is actually increasing, growing support favoring a British exit from the European Union. Currency markets reacting to the news this morning. What's your take here? The referendum is on June 23rd, Doug. We may very well say the UK vote to leave the EU.
We may, and there will be economic repercussions. I don't think it's the cataclysm that most people seem to expect. I'm puzzled by that. I will say it's a political disaster. The UK leaving the EU leaves the EU in a very precarious state. It was always a political union. It wasn't an economic force. It was designed to give Europe a big voice on the global stage. You know, if the United Kingdom leaves and then Scotland leaves the United Kingdom to stay in the EU, the door's open for the EU to simply disintegrate. And that's the bigger implication. That'll take longer, but that's what's worth watching.